The State of Crypto is presented by Tron, connecting the world to the power of cryptocurrency.
Now to discuss is Sultan Meghji. He is Duke University professor and former chief innovation officer at the FDIC. Welcome, Sultan. All right, so let's get to it. I mean, right in the beginning, we talked about Celsius changing lawyers, and I understand that the FDIC is going to be investigating Celsius as well as Voyager Digital's insurance claims. Any insights into what those discussions might look like?
Well, I'm sure they're not comfortable on anyone's radar right now. But the fact is, these are mostly non-regulated institutions that are operating in some cases through a banking partner offering some sort of banking as a service. And, in my tenure at FDIC, we came down pretty hard on non-regulated entities, insisting that they were insured in some way by the U.S. government, and none of them were directly. In some cases, they'll have a U.S. dollar account inside of a banking as a service provider, and then there'll be some degree of protections there. But the fact is the regulatory regimes of the United States currently do not have a mechanism to regulate any of these entities directly. It's always through a partner or through some sort of consumer protection function or something like that. So this is sort of trying to close the door after the horses have left the barn, and the current regulatory environment really is just trying to use enforcement actions against the banking as a service providers to start to get a handle on this.
What about with Three Arrows Capital? So now we see that the creditors are trying to salvage whatever assets that they can and get returned. Normally if a bank were to go bankrupt, you could trust the FDIC. In this case, what can crypto investors rely on?
Frankly, nothing. This is one of the challenges, and why I think it's important for us to find ways for responsible crypto actors to get inside of the regulatory perimeter. It's what we call it. And there are a lot of really interesting conversations going on there, especially in Europe. The G20 is moving forward on some stablecoin activity. The U.S. government has started to move forward on that, and then kind of paused a lot of the interesting conversations there. But this is a thing that people have to remember: is the vast majority of crypto providers, there is no regulatory support for them. So, with Three Arrows as the example, you've got multiple different jurisdictions, you've got multiple different actors, but frankly, none of them really have an ability to go and say these assets can be distributed in a certain way, other through normal, business operational functions, like with lawyers. You can't have a group of FDIC Suburbans roll up and just take over the assets and start making sure that the investors are taken care of.
So we saw with Voyager, there's a question as to whether or not they were marketing that their deposits were FDIC insured, I guess the question is, what exactly did they mean here? I mean, was it that they opened up individual accounts at FDIC insured banks, or that they had one account at an FDIC insured bank? But either way, what are the repercussions for Voyager? Should it come out that, or should it be perceived that they were advertising that the accounts were FDIC insured? I mean, were they not?
This is an amazingly important question, and one where kind of everything you just said could be true. And I have to be just a little careful, because obviously I'm still governed by certain privacy issues as it relates to my previous job in the federal government. But, I can speak in a kind of a broadly hypothetical setting that a lot of organizations have gotten smacked around over the last few years because they've been advertising something that's patently not true. So if you are a crypto provider and you're saying that each individual account is a FDIC insured institution, well, that's just not possible. And there are these things called action letters, and I can tell you more than non-zero number of those went out to a number of players in this space during my tenure. The fact is, go ahead.
Yet they hire all these lawyers that work for them, and this is a publicly traded company, and they have a lot of compliance officers, et cetera. Was there nobody there who said, gee, this isn't exactly how this works? I mean, what exactly happens? Is it a game of companies just saying, all right, let's see how far we can get away with this, or is it just, incompetence?
Well, Shoot, I was going to say the former, but I think a little bit of the former and a little bit of the latter. But certainly the former has been true for the last few years. A lot of players, because there's so much gray area in the regulatory system right now in the United States, certainly it's one of the, there's good to that and there's bad to that. In a good sense, it allows innovative people to really push the envelope, and in a bad sense, these organizations are years, if not decades, in some cases ahead of where the regulatory regime actually is. And that leaves people exposed, whether it's an individual investor or a participant in that crypto company or the banking as a service player. I think, if I was any of the banking as a service providers who were, sitting behind organizations like the ones we're talking about, I would absolutely be amping up my regulatory and risk management infrastructure, because I'm sure they're getting phone calls from every company that's just been mentioned in the last 5 minutes.
You mentioned regulatory gray area, and we're finding a statement this morning from a global financial watchdog, the Financial Stability Board, and they're saying that they want to propose recommendations for stablecoin regulation and submit a report on recommended rules for other crypto assets to the G20 in October. And I guess therein lies the problem, because I'm just talking to some folks, and they say in Switzerland, it's not that they're regulatory lax, it's that they're very clear, and perhaps that clarity does not exist in other jurisdictions like the United States. And so I'm wondering if this kind of proposal, could it be applied in a more global sense? Do you think that would catch on with regulators from different countries?
This is a huge and really interesting story that I really hope people pay attention to, between what the Financial Stability Board is doing, what the Basel guys have been doing over the last few months. Both of them are putting forward some really interesting and, frankly, far more interesting than anything we're really seeing here in the U.S. that's going to become law anyway, programs that might actually be really valuable for all of the major industrialized economic powers. In both of those cases, though, both with Basel and with the Financial Stability Board, these are great proposals, but it will take 18 to 24 months for those to get implemented in any meaningful way. It also, in both cases, they're fixated exclusively on stablecoins, which we all know, is a very small subset of this entire market. And so, and then you take the third example I would give is the Lummis-Gillibrand proposal here in the US, and that's operating in a different way. It's important for people to remember that the regulatory regime of the United States versus, for example, a Switzerland is really quite different. In Switzerland, it is everything is illegal except for the things we tell you that are legal. In the United States, is everything is legal until we tell you it's not legal, basically. And those are two radically different psychologies to bring in. And so while the FSB and the Basel stuff is interesting, we've seen for decades that when those proposals make it their way to the United States, there's kind of a grinding that has to happen. And really only a subset of that comes in. I mean, things that were proposed and acted on in 2008 were just becoming operational in 2020 and 2021 at the FDIC. So it does take quite a while for those to get into the American system.
Do you think that the projects that are going bankrupt, getting proceedings now, that they'll retroactively be regulated by these regulators?
Ooh, that's going to be a tough one. I think that's going to be a really tough thing to do. The vast majority of time when new regulations are proposed, the process is they make a proposal, it goes out for public comment, they do a cycle or two of public comment, then it is said, okay, we're going to pass this, it's going to become legal, and it's going to become legal after a certain date. And that's how that's going to move forward.
All right.
Do you think that this accelerates anything?
I wish it would, but I'm not convinced. I think we're in a situation where there's a lot of activity in the regulatory system in the U.S. as it relates to enforcement actions, and we see that at SEC, we see it at FDIC, we see it at CFPB, which are really all trying to beef up their enforcement functions in order to kind of attack this a little more aggressively and to try to drive it out of the system. From a legislative process, which is really how this is going to get solved here in the United States, getting something through Congress right now is pretty difficult. I think that's the understatement of the week, although we have CPI coming out, so probably not. And we've got a midterm coming up. We have a presidential election 2 years after that. It is hard for me to see how anything gets done this year in the United States that's really kind of legislatively meaningful. Next year, it's going to entirely depend on the makeup of Congress, which, is looking like it's going to be at least a mixed House and Senate. Maybe both go to the Republicans. That then creates a new tension. And so it's, it wouldn't be at all out of the realm of possibility that we don't see any actual action on this until after the 2024 presidential inauguration.